corporate governance in the commercial banks. Both those speakers did a much better job than I'll be able to do for you because they spoke the reality of what we are going through as a country. What I'm going to spend time is actually to sort of suggest to you that what they are talking about actually begins with you. Whether you're in practice, whether you are a gatekeeper, a bookkeeper, a reporter, a preparer in the business. If you look at the structure of accountability and corporate governance, at the root of it is actually financial reporting. There's always the first line of defense, which is the management, the people who run the business, who manage, and they would get into all sorts of fraudulent activities, malpractices, and so forth. The second line of defense in any business, in any corporate, is generally accountants. Whether they are performing their role within the business as bookkeepers, or they are performing their role as enforcers of compliance, or performing their role as enforcers of detection, and that is the internal audit role, or in their role as external auditors who will come to certify the financial statements of the corporate or the business. And this, whether it's in public sector or private sector. And therefore, for you to be able to perform that role of second line of defense, you need to be aware of what standards you need to be complying with, what is happening in your professional world. And that is, in summary, I know as an institute we run a lot of training, and there will be an opportunity to go into details of some of these standards and actually reflect on some of the things that are happening in these standards. Can I just anchor this by at very high level telling you what's going on in the financial reporting world? And I'll start from the ISB. The ISB is the body, the International Accounting Standards Board, that deals with the issue of accounting standards, which we now call IFRSs. Okay, and then I'll talk about what's happening in the IASB, which is the body that deals with the auditing and assurance standards. What is the key agenda? What's the drive of the agenda here? The ISB, if you remember back from the financial crisis of 2007, 2008, going into bits of 2009, clearly exposed massive gaps in our financial reporting standards. Gaps in the interpretation of those standards, or comprehensiveness of those standards, or the consistent application of those standards across the world. And therefore, the ISB embarked on a project of trying to drive the changes in financial reporting standards around improving the clarity of those standards, and particularly the complex areas of financial instruments and business combinations. There were different treatment of those depending on which part of the world you are. Financial instruments were treated differently depending on which part of the world you are. Business combinations were accounted and reported for differently. So the whole idea was to close the gap around the standards that cover those areas. And there was a flurry of many other revisions in the standards that happened to be consistent with these changes that are coming across these particular two areas. The whole theme, if you looked at it largely, was to try and emphasize fair value reporting of assets and liabilities around the balance sheet. That people at any point want to know the real fair value of the assets and liabilities that are actually around the balance sheet or the statements of financial position. The second agenda that underpinned the activities that started in 2009 was around creating consistency in the reporting framework. So you've got the ISB, which is the International Accounting Standards Board, dealing with most of the financial reporting on the largest part of the world. But you've got the Americans with their Financial Accounting Standards Board, which has their own rule-based standards. Those two frameworks actually had massive differences, and depending on which framework any business adopted, they would actually end up with very different looking financial statements. So there was discussions happening around the ISB and the AFB, so can we bring convergence so that we have consistent and harmonious reporting across the globe? So that if I picked up financial statements in Kenya of Safaricom, and I'm sitting in Korea, and you're talking about post-employment benefits, I'll be able to understand that this is exactly how we would have accounted for them in Korea. So that project has been going on. To be honest with you, the world have recovered from 2009 and it has slowed down. I don't think it's got as much impetus as it had then. So those were the two key agendas that have been driving the ISB since 2009. Between 2009 and 2011, there was a flurry of new standards that came up around financial instruments, around business combinations, and some of those standards continue to be deferred, some have become effective, and so forth. But seriously speaking, from 2012, 2013, we got what is called a stable platform. So it was a stable platform in the sense of there are so many standards that have come into place. Let's reflect on the effect of these standards, what issues are coming in the implementation of some of these standards. And I'm going to show you some of the issues now that are being dealt with, actually coming out of that agenda of 2009-2010. What's happening in the ISB? The ISB were two issues that arose out of 2009-2008 financial crisis. One was the quality, the robustness of our audit processes for the auditors. And two was the agenda of the quality of the auditor reporting. Is the auditor reporting actually helpful to the users of financial statements, to the investors, the public that use their reports? So those were the two issues that needed to be dealt with. So what happened? The project started off ISA Clarity, and for you who follow the whole agenda of the international standards on auditing, there have been Clarity ISAs being churned out every year, basically improving in our old auditing standards, trying to bring in clarity on how the auditors should actually execute their audits, what they should be doing, what judgment should be going through the auditor process, how they should be going around risk assessment. That has been agenda. That continues to be agenda. And I'm going to tell you shortly where we are around that. I'm going to talk to you about the enhancement on the auditor reporting, something that I think for some of you, you've seen as professional science committee, we've spent the past 6 months trying to talk to regulators, preparing the businesses that this standard is coming, it has implications, and there is need to prepare for it. And I'll talk to you some of the changes that are coming out of that. So if I take that sort of to be the high-level introduction, please allow me then to dive into some of the changes that are actually happening, or what's actually happening at the in our professional reporting at the moment, if that works. Yes. So I'll spend a bit of time talking to you about what is the current activities at the ISB, IASB. I'll talk to you about the new standards and some of the key standards that are actually going to affect the market. And for you who are in businesses, wherever you're sitting, these standards will affect you. I'll tell you at a very high level what issues that you'll actually be talking about. I'll then very quickly run to you about some local regulatory changes that are going to affect financial reporting, are going to affect the way practitioners engage with the businesses, where they are either as managers of the businesses or actually external assurance teams. I think then Edwin will come in and talk to you about the whole agenda of education, ethics, and the public sector, the IPSAS agenda in the public sector. So very quickly, what's happening? For you in the insurance business, IFRS 4, there is the phase 2 of it. That is still under drafting. There's been a lot of back and forth around what should be the agenda around IFRS 4. And I tell you the big issue around IFRS 4 phase 2 is simply because of one of the standards we're going to look at, which is IFRS 15 around revenue recognition. There are a couple of issues that need to be reconciled between IFRS 4 and the way the approach is supposed to be taken on revenue recognition under IFRS 15. And that is where basically that standard is. We're hoping that there will be a draft, an exposure draft coming out this quarter. Actually, we're going towards the end of the quarter. We don't know whether it's still on the agenda, but that's happening there. Conceptual framework. For you who know, the conceptual framework is the underlying platform. All the standards are drafted and published based on what we call the conceptual framework. The conceptual framework is where you go to find guidance on how you deal with a matter that might not be obvious in the standard when you read it. So what's the definition of an asset? What's the definition of a liability? How do you deal with the whole issue of prudence? Is prudence the same as cautiousness? Being cautious, exercising caution, and so forth. All those things are dealt with in the conceptual framework. Now, with the new standards, and particularly since 2009 with the new standards dealing with the issues of fair values and all sorts of new accounting approaches that have actually been introduced by the standards, there are gaps in our conceptual framework that needs to be dealt with. And therefore, there is an agenda that's actually going on at the moment. In fact, I think about late last year, as a professional standards committee, we actually responded to the comment letter coming out of this particular subject. So we're expecting that there's actually going to be a new conceptual framework that will be issued by the end of this year that will support particularly all the new standards that we've had. Share-based payments, here we're talking about employee share-based payments and so forth. That is a standard that has been in place. There are some clarifications around classification and measurement that need to be dealt with, and that's also in the drafting stage. IS1, which is basically the standard around presentation of financial statements and so forth, there's, again, a lot of these changes are coming out of the new standards, where you find you've issued a standard and there's now inconsistency between how do you classify a non-current liability. Is it a non-current liability? Is it not a non-current liability? And that such inconsistencies. And we see a lot of this happening every year. IFRS 3 and 11, those are amendments. Those standards have been around since 2010, I believe, when they became effective. What's happening here is they're just being refined. As every new standard is actually issued, you realize there's an issue in an existing standard that needs to be reflected on. In this case, we're dealing with the issue of if you are actually a party to a joint arrangement. A joint arrangement, you own 50-50, or whatever definition you arrived at, but you've defined as a joint arrangement. And then suddenly you take control. How do you deal with the remeasurement of the previously existing interest as you move into control? Because the control means you now move to consolidation. How do you actually deal with the stake you are holding? Those are issues that are being dealt with. And then there is a lot of such projects that are going on around impairment. Goodwill is a very old story, as you all know. Back then in the 90s, the 80s, the old accountants, goodwill, you always determined it. The determination of goodwill has never changed. What has kept changing is how do you deal with goodwill after you've determined it. A couple of years ago, back in the 80s and the 90s, you had to define a period within which you think you'll be able to utilize to benefit from that goodwill and amortize it over that period. And I remember once you decided it's 20 years, you could not actually change it. You had to amortize it over that 20 years unless it's determined as impaired. The approach on impairment was very different. The new standard came in, IFRS 3, and completely changed the way, the whole concept of how do you actually approach the whole impairment testing for goodwill. You're given two approaches, value in use, fair value. Which is which? How do you end up with the conclusion that the goodwill is not impaired and all that? And there's a lot of judgment involved in that. That area is being looked at. There are question marks on whether goodwill should actually still be sitting as a permanent asset on the statement of financial position. So that's being discussed. I won't be surprised if we get back and actually go back to say, no, actually, if you say you paid a goodwill, it will only benefit you for a finite period, and you need to amortize that goodwill over that period. Or it may actually go back to say there is an option actually that you can write it off immediately. So we have to wait to see where that is going to go, but there is actually going to be an exposure draft or changes coming out of that project. Definition of a definition of a business is being relooked at again. What is a business and what's an asset? If I go there and I buy a generator that supplies power to KPLC, did I buy an asset or did I buy a business? Very judgmental, very difficult decisions to deal with. Because depending on how you make that judgment on whether it was a business or an asset, you may end up with a goodwill or no goodwill on your balance sheet. We want to bring more clarity around that, and that's part of the considerations and discussions that are going on in that space. If it moves. Somebody help? This is stuck. Yeah, that's what I'm pressing. Okay, so in terms of ISAs, what's happening around ISAs? I think I talked about the whole issue of the quality and robustness of the auditor's processes. There were a lot of issues around how does the auditor get the assurance and comfort around estimates, areas of judgment. So the management have made their estimate, be it LIBOR costs, what they think it will result, be it environmental costs, be it any sort of estimates that might go into the financial statements, up to and including impairment of loans and advances. To a very large extent, there's a lot of estimates that go in there. There is discussions in trying to actually improve ISA 540 around the auditor's processes and the auditor's procedures around auditing for accounting estimates. Okay? ISA 600, and I think for Kenyans in particular, for the auditors, is that increasingly our businesses are now becoming groups, going regional, subsidiaries in the other East African countries. You've started to rely on other auditors out there. And it turns out that probably some of the profit that you are reporting in Kenya, to a very large extent, most of that profit is actually coming out of another country. The majority of the work is actually done in another country. How does the auditor, what procedures and what considerations the auditor should be going through? Okay? ISA 315, risks assessment. For those of you who are in practice, risk assessment is the cornerstone of a quality audit process. If you don't get your risk assessment right, trying to understand what are the significant issues, what are the complex areas, where do you need to have to focus your audit process, that audit quality will fail. So basically what we're trying to do is to see improvements around 315 or the identification of risk, and particularly do you understand the business that you're auditing? Do you really understand how that business makes money? Do you understand the areas that are prone to misstatement in that business, the key areas of judgment and estimates in that business? Those are sort of issues that are trying to be strengthened. Integrated reporting, and I think we've seen a number of Kenyan businesses doing a lot of very nice integrated reporting, Safaricom, Barclays, KCB. This is an area that as accountants we need to embrace, we need to bring within our own auditing framework. Some of these reports, integrated reports, are now coming out with financial statements. Now, when we look at the issue around auditor reporting, there is now a greater emphasis around consistency of information, other information getting out together with the financial statements. As the auditor, are you comfortable that the information that's being put in all these integrated reports is actually consistent with the financial statements and the report you are issuing on the financial statements? So this actually also an agenda. Deliberations are going on. How do we improve the auditor's processes, the auditor's procedures around integrated reporting? I know I'm rushing through this at very high speed given the time limits, but I want just to highlight to you a couple of standards that are going to become effective in the next 2 to 3 years in the market that you all need to be aware of, and they'll affect different businesses differently. So, right. So the first one is IFRS 9, and I'll deep dive at very high level into that standard, just show you what are the key principles and changes coming out. IFRS 14, this standard actually primarily applies to first-time adopters, and Kenya as a country, we are way beyond that, so I don't want to spend any time around that. IFRS 15 are revenue from contracts and customers. I'll do a quick deep dive on that, and then IFRS 16 around leases. IFRS for SMEs, for whatever reason, IFRS for SMEs has never really worked in this market, and as the Professional Standards Committee, we keep reflecting on why does this standard actually be applied. It can remove a lot of complexities in the audit process. It can bring quick compliance to a lot of businesses, but somehow this standard has never really been fully adopted by a lot of businesses in the market. So IFRS 9, what are the main changes around IFRS 9? Okay. So I want to jump out of all this, and I think you'll get the slides, so I don't want to spend a lot of time on this. What I had captured there, just the various standards that are becoming effective this year. For you who are involved in financial reporting as auditors and all that, it's a quick sort of portfolio of various standards and changes that are becoming effective 1st January 2016. So as you deal with the financial reporting this year, you need to pay attention to all those standards. And let me not go through each of them, but they're out there, you'll see them on the slides. The ones I want to highlight at very high level is, one is IFRS 9. Okay. This standard is going to have massive implications in financial reporting, particularly of financial institutions. And for you who are in insurance companies, they're in banks, in financial institutions in general, you should already be having projects to respond to what this standard is actually bringing. It brings significant and fundamental changes in the way we've dealt with certain issues around the classification of assets in particular. If you have financial assets, how do you actually classify them in your balance sheet? It brings major changes around the impairment model you've applied on your financial assets. The current principle about impairment of assets is the incurred loss. So you only book the impairment when you believe you've incurred the loss. Okay? What do you mean by incurred the loss? The event, the loss triggering event has occurred, okay? And you can either reliably estimate that loss, or you can't, but you have a historical experience of being able to say generally, this is the amount of loss that would arise from such events. And therefore, people who are in insurance, you'd have the so-called IBNR, incurred but not reported, okay? Or actually incurred, reported, but not estimated, quantified. That is the model that exists. The banks would say there's been default. So the default event has taken place. And once the default event has taken place, the standard tells you, IS 39, that you need to estimate the recoverable value of that asset, which is your loan, and compare it to your carrying value. And the difference is what you need to book as impaired loss. So it's always, there's been a default, there's been a loss event, and therefore we need to estimate the loss that we've actually suffered. What the standard is actually now introducing is the model called expected credit loss model, where basically you say that if you bring your asset on the balance sheet, the first question you need to ask yourself is that does this asset generally in its lifetime result into a loss? And if in its lifetime it results into a loss, how do I estimate that loss and book it on initial recognition? So if you have a loan and you're doing a retail loan, consumer book, what is your experience around the loss in your consumer book? And that loss needs to be booked irrespective of whether it's been incurred or not. So you need to anticipate that loss and book it. Talk to your auditors, talk to your professional advisors. It's a fundamental change in the way financial institutions report. And it will actually significantly change the amount of impairment loss most financial institutions are going to book in their financial statements. That's all I want to talk about that standard. It's a key standard. I think a lot of banks should be worried about it, and insurance companies. The next standard I want to talk about is IFRS 15, which is basically a massive change and improvement on the current IAS 18, which is our revenue recognition standard. And basically what this standard has gone is that it has actually broken down the whole process of how do you determine when to account and report revenue. And it has created more or less rules and detailed guidance in every aspect of contracts for you to determine, are there multiple transactions? What is the price? How do I allocate that price to the various obligations that I need to deliver? Have I delivered the obligation? At the bottom line is that you can only recognize revenue if you have delivered the obligation under the contract. Again, it's going to significantly change the financial reporting of businesses in the telecom space, businesses in the advertising space, and actually at times, businesses in the financial sector, where you find at times they have bundled services. If you have bundled services, you have a loan. That loan in there, you've thrown in your normal service fee, you've thrown in your sweetener for the customer to sign on, you've actually thrown in yield enhancing fees. Because you are saying, actually, I'm giving you that loan at 12.5%. But what you've done, you've actually thrown 2% in fees so that the real interest rate you're getting on that loan is 14%. That number is hidden with other charges. You need to unbundle all those things. You need then to determine, how do I recognize revenue on this? So again, it's a standard that I urge you, fellow CPS, to reflect wherever you are sitting, look at that standard, talk to your professional advisors on how does this standard affect you. The final standard I want to talk about again that is going to bring massive changes is the accounting for leases. Something that has always been very straightforward in our lifetime. It was either an operating lease or a finance lease. And if it was a finance lease, you brought, as a lessee, you brought that asset on your balance sheet and you recognize the liability. If it was an operating lease, you've just rented the building for 40 years and I'm just paying rent. That building, at the end of that lease, I'll give it back. It's simply rent, and it's the only thing I recognize as an expense. Part of the convergence agenda of ISB and FSB is now to bring all significant leases onto your balance sheet. So what's going to happen is that you're going to find those leases you have for 20 years, recognizing that building on your balance sheet and related liability into your liabilities. And how do you determine what you need to recognize? Is basically the present value of the committed payments that you will make over the lifetime of that lease. This will completely change the balance sheets as we see them, particularly businesses that have long leases that they enter into, banks with branches all over the country with long-term leases, and so many other businesses that are affected. So again, it's a standard you need to reflect on. It may actually affect some of the performance ratios or the way actually people look at your balance sheet. So those are the three standards. I'm really keeping them at very high level that I urge you to look at them very carefully. These three standards are on average 2 to 3 years away, but the implementation actually is a retrospective restatement. So in fact, you will need to restate your numbers from this year, 2016. And that's why it is important that you reflect on them, see how they'll impact you, start preparing your stakeholders and telling them, whereas I've actually reported a profit of 21 billion, in 2 years' time I restate this number to 15 billion because of these standards that are going to come in. Okay? So those are the standards I want to talk about around the recent standards that you need to reflect on. And as I said, there are so many other things in there, in other standards, minor changes and so forth that you need to reflect on. Please allow me to very quickly talk to you about the ISAs. As I said in the ISAs, the key agenda was clarity ISA, improve the quality, the robustness of the auditor processes, bring quality there, make sure that the auditors are able to deliver quality audits by complying with the ISAs that support the audit processes. But at the same time, improve the auditor reporting, enhance the quality of the auditor reports. And I think today what I want to do is spend more time around the ISA 700 changes, ISA 701 in particular, and many other ISAs that are related to that. And there are many other modifications and changes, revisions that are going on as a result of the enhancement in the auditor reporting process. I'll touch a bit on that. What has changed? Basically, the auditor report has been enhanced. The auditor report from this year, when you look at the financial statements, the auditor report will never look like what you ever used to. It will be a completely different report. And we've been engaging with the regulators to make sure that they actually start preparing the organizations and the businesses that they regulate on how these reports will be implemented, to make sure that it's not skewed in one way or it's being properly and uniformly applied in the market. What will be many changes at very high level? The stakeholders, the people who use the auditor's report said, you know, when I pick the auditor's report, it is 7-8 paragraphs. I have to read through all paragraph 1 to 7 to only get one small paragraph that says the financial statements present a true and fair view. Please just tell me that first. Okay? So tell me the financial statements present a true and fair view first. Then the next thing is then give me affirmative statements on your responsibility, how you performed the audit, the responsibility of the management, and if there are issues of going concern, I want to hear about those issues. Please give me some more descriptive disclosures around your independence and compliance with the ethical standards. So in all the reports, be it the smallest business and all that, you're actually going to see that is going to be the format of the auditor's report from 2016 All reports issued for 31st December year-end this year, they will comply with that format. But the most significant change is around the listed entities. The listed entities, there's been an introduction by ISA 701, and I urge you to read that standard, on what is called communication of the key audit matters. The key audit matters that the auditor dealt with in the audit of those financial statements to arrive at their conclusion. Partner, for 11 years, I can assure you there is a lot of discussions that happen behind closed doors with the directors to conclude on the auditor's report. As a reader of financial statements, you will never know what we discussed, what did I do, and how did I arrive at my conclusion. All you'll just see is the financial statements present a true and fair view. Basically, what most the public said is that I actually want to know what were those issues. What were the key considerations in those issues that made you spend so much time on them? What procedures did you carry out? And then give me a general feel of what was your overall conclusion on those particular issues without supplanting your overall conclusion on the financial statements. That's basically, in summary, the key audit matter. So, for listed entities for this year, you are going to see 4, 5, 7 pages of auditor's reports. These are not problems with the business. These are basically issues that came out of the auditor's assessment of the risk. What is the significant risk assessment in that business that the auditor had to focus on? What are the complex areas in those businesses that the auditor had to focus on? What are the most significant estimates that the management made that the auditors had to spend a lot of time to conclude on? So that you can get a flavor of what went on the auditor process. So you're going to see that coming through all the financial statements of listed entities. We are very actively sensitizing the regulators. We had a session with the non-executive directors and actually the directors of listed entities to actually sensitize them on what this standard means. It will require professional judgment. It will require very delicate language in the sense that as the auditor, you will need to be able to communicate in a manner that a layman can understand that issue. So you don't write it to an accountant. You are writing to an ordinary investor from Kakamega. So in a manner that you'll be able to understand what you are talking about, what was the issue. Okay? And yet, making sure that you do not water down the significance and the weight of the issue that you are dealing with. So it will be a very delicate issue for the auditors. It will require a lot of back and forth to actually agree with the directors, because it's also very easy to misrepresent the real issues and the facts behind that issue. The key thing that I can assure that this is going to also drive is that you're going to see a lot of disclosures in the financial statements, now driven by the directors themselves, because the auditor will say, I actually want you to give full disclosure of this issue in the financial statements, and then I'll start by referring to your disclosures, rather than me trying to characterize the issue for you. So you're going to see actually improvements in the disclosure and financial statements, or at least I hope that that's what's going to happen. What are some of the issues? I just skip some of this, whatever. What are some of the issues for you who are either practitioners in the businesses? These are the usual suspects of issues in the businesses that you never really get to talk about. Acquisitions and disposals, how were those accounted for? Was it an asset? Was it a business? I was just talking about that. Did they buy a business? Did they buy an asset? How did they determine goodwill? Is their justification of goodwill right? Have they impairment tested it properly? Are the assumptions sensible? What work did you do to that? Okay? Inventory valuation. In some, you might find very complex inventories. How have they been valued? Is it consistent? Revenue recognition, we've just talked about that. Multiple contracts, multiple arrangements. Have the obligations been delivered? What judgments do they make in allocating the contractual price, the various multiple obligations that they've got to deliver? Claims and litigation, taxation, and in particular, the deferred tax. they've recognized an asset because they've got accumulated losses, or they've got some provisions that they've never utilized. Will they ever be utilized? Is it really an asset? What judgments have they arrived at to make? What judgments have they made to arrive to decide it's an asset? Valuations and impairment of PPE. Has the whole industry shifted, the whole sector shifted, that actually they'll never be able to recover the investment they made in their PPE, in their plant and all that? Have they given the true story of really whether that's the recoverable value? Management override of controls. Are there frauds, significant frauds? If there was a significant fraud at the moment in a business that is being audited, it will never end up in the auditor's report. It will be in the post-audit report, it will be the report to the directors and so forth, and then accounting will happen, and that will be the end of story. In the current reporting, you may find that the fraud is so significant that actually the auditor has to cover it as a key audit matter. On how satisfied are you that that fraud does not actually persist within the business? That it does not actually affect, it's not pervasive to the whole financial statements that you are reporting on. So this, just a sort of a flavor. This is very high level. So I said, talk to your advisors. The last one I want to talk around is just around going concern. At the moment, if there's uncertainty around going concern, what the auditor does is that he puts a statement after his opinion, which says true and fair view and all that, and he says emphasis of matter. And then he says, as disclosed in note XYZ, there is significant uncertainty. In fact, starts to say without qualifying. Yeah? Now, the 570 ISA requires you to actually disclose, give detailed disclosures around going concern, what judgments and managers have made, and you as the auditor, how comfortable are you? So you're going to find in a business where there's going concern issues, there will be significant disclosures in the auditor's report around going concern. Very quickly, for the sake of time, then there are several amendments that are actually coming through in the ISAs related to the enhanced auditor report. The main one is around the disclosure project. As I said, because the auditor's report is going to be 5-6 pages, the auditor is not going to take responsibility for the financial statement. So you, as the auditor, you're not going to disclose what the directors failed to disclose. So that means that there's going to be more detailed disclosures in the financial statements. So what does that mean? Is that the auditor needs to audit those disclosures. And therefore, there's revisions around the ISAs to enhance the auditor's processes and robustness around the audit of disclosures. At the moment, for those of you who are in practice, there's always something called materiality. And in most cases, we look materiality from the concept of quantitativeness. 4 billion. There is now materiality arising from disclosures, where these qualitative, significant disclosures that were not made in those financial statements. And they may very well result in a qualification, or a modification of your auditor's report. And then there are related changes that are coming through other standards, which I don't want to spend time on. So I'll jump through that. Take you through, there are all those ISA 810, and just basically now reporting special purpose financial statements, or reporting on things like summary financial statements and all that. So they're also enhancing all the auditors report around those financial statements. I think when you see the slides, you can look very quickly through that. Very high level regulatory changes. Some of these regulatory changes are going to, again, to affect us. The key one is the Companies Act 2015, phase 1, implemented. Phase 2, we believe it should come on board by 30th of June. There's a lot of discussions and regulations that are actually going around. Some of you might have seen them. Be aware of those changes. Some of those changes affect our role as accountants. Some of those changes affect our role as auditors. And that's all I want to talk about. They all summarize some of the key changes out there. CMA issued their 2015 regulatory guidelines. Corporate governance, what they're calling Code of Corporate Governance. Yeah, the Code of Corporate Governance Practices 2016. Again, a lot of changes that have been brought by that code that places quite a bit of responsibilities around the auditors, our role as accountants, and particularly our role as accountants sitting in those instruments that are charged with governance. So if you are on the board, there's a lot of responsibilities that are now being placed around you on how that board should run. how it has to do its business, the composition of that board. And then as the auditors, the real responsibilities around your conduct that actually comes through that. And then finally, just to highlight to you that there is a new bill around the Financial Services Authority that I believe was published probably 2 weeks or 3 weeks ago. Basically, what this bill is doing is long overdue to collapse all these regulators, something we've always agitated over the past probably 10 years. To say there's no need to have a regulator of insurance, a regulator of banks, a regulator of retirement benefits, regulators of cooperatives, and all that. Each of them, they are pulling their own strings, affecting small sectors. But actually, when you look at the issues they are dealing with, they cut across. You need to bring them under one single umbrella and put them under one regulatory framework. And that's, I think, what this bill is introducing. Colleagues, I beg to stop there. It's been a very high level, but I'm sure there'll be an opportunity for you to look at this into details. Thank you very much. Yeah.
Thank you, CPA Michael. Just to be able to highlight is that some of the changes that CPA Michael Mugasa has put across is that we, as an institute, have keenly engaged the regulators to be able to ensure that this is in the purview of the regulators, and most of the regulators have agreed. Whether most of these particular standards that are being revised, ISO 701, is basically for listed companies, but I know even the Auditor General here has agreed that they're going to adopt that particular standard, and that is going to be the reporting from the end of this particular year. Just to be able to continue from where Michael Mugasa has stopped, is just to be able to quickly highlight on the anti-money laundering law that came into effect in 2009, and we as accountants are expected to be able to familiarize ourselves with this particular law, because we are what we call a reporting institution. And in this, therefore, any transaction that relates to anti-money laundering or crimes of financial terrorism, we are meant to report this to a unit that was formed under the Act, which is called the Financial Reporting Center. This particular law has been reviewed and Parliament has passed new amendments to it. The fines are very punitive. For individuals, it goes up to as much as 5 million. For entities, is 20 million. So I'll urge the professionals to be able to relook at this particular law and be able to familiarize themselves with what is happening, especially on issues to do with anti-money laundering. And what is key is that now you'll have to know your customer, what we call the KYC, be able to get proper records of who your customer is. And I'm sure for those who are in the banking sector and insurance sector, that happened a while ago, and they always have a KYC for all their customers. But now for the practitioners and all other accountants who are going to practice, then this is a time now, even as you carry on or take on a new engagement, you need to be able to know your customer and get all the relevant information before you accept that particular engagement, because when the Financial Reporting Center will be coming to you, you will not say that you didn't know that particular customer. Moving on to accounting and education, and I was what we call the initial professional development, and after that we have what we call the continuous professional development, that is why all of us are here, to be able to take up a CPD program, just not for the hours, but to be able to learn something out of it. With that, there is another new standard that has come in on specialization, but that specialization is now for engagement partners are responsible for financial statement. What competence areas do they need to be able to develop and maintain on a continuous basis? Just to be able to look at that is that, therefore, for this particular standard has two portions, which is the pre-qualification and post-qualification of as an accountant, professional accountant, and therefore there are standards that are going to guide, and where we are is on post-qualification, the CPD and IS8 that is specific to engagement partners who are responsible for financial statements. The approach that the Education Standard Board has taken is to be able to shift to what we call a learning outcomes approach. And in the learning outcomes approach, what will happen is that it's no longer an issue of now coming in, sitting, listening to the presentation and leaving. The board is considering the issue of what do you get out of that particular training? How does it assist you in performance of your work? And does it improve you as a professional accountant? Did you gain something that you take back to your employer or to your organization to be able to implement and become a better professional and be able to provide better services to your organization? So basically what is happening is just to be able to enhance the benefits. I'll leave this, the slides will be presented to be able to show what are the benefits of this. But a brief snapshot of the learning outcomes is just the last part of it on the far end, the assessment part, where you'll be required either to take a module exam or a multiple choice test, an essay, a report on a research or a project or practical assessment, a field work, a portfolio of all the above, a performance evaluation of what you learned from a particular training, and many others that the board is trying to consider. The initial standards, which are the initial professional development, have now been tailored to what we call a learning outcomes. The project that is currently ongoing is on CPD and specializations that come out of post-qualification. As you can see from that particular slide, you need to be able to get the relevant CPD after your pre-qualification, so that one, that CPD is going to either assist you in your promotion or is going to assist you in a new role that you're going to take as you move up the ladder of an organization, or as you take on a new job. Then you need to be able to see what is this CPD requirement that I need to be able to equip me to be able to take up that particular new role. And what has happened is that for the CPD activities, then there is a combination of what is being looked at, and there's training, there's education, there's an issue of coaching, there's an issue of networking, and being able to see how do networks assist you to be able to get additional knowledge on your area of expertise. And some of these will be self-directed or unstructured in the way you do it. And this should be able to address two public interest issues. One is a compliance issue, and two is effectiveness, whereby you as a professional are going to be effective in how you carry out your professional duty. In essence, therefore, what it means that you'll have to self-appraise yourself, do a proper plan on how you'll be able to carry out your continuous professional development, act on it by attending the given training, and be able to document. And lastly, there's going to be an evaluation process to be able to see how that evaluation is going to be carried out. This has a direct effect on the board is actually currently looking at the revision of I7 on continuous professional development, so that it has two elements in it. The service providers who are going to provide CPD, how are they going to carry out the CPD program, so that at the end of it all, the compliance and effectiveness is achieved from that particular professional. And one of the methods that the board is critically discussing and is trying to eliminate is what we call the input method. The input method is what we have currently, where you come in, sit, go through a slide, somebody makes a presentation, and after that, you leave. You get your CPD hours. The board is feeling that that particular method is not being effective because what is it that you're transferring back to your organization? I think the other bit is the competence requirements for those who are responsible for financial statements, the engagement partners who are going to be responsible for financial statements. I don't want to go too much into this. We provide technical guidance on this. But there's a requirement now for those professionals to be able to develop and maintain some key competencies as they carry out their duties. And this particular standard is effective from July 1st of this year. Just to move quickly to what the work plan is, the current projects that are being undertaken by ISB is the continuous professional development, the IS7, and that's the reason why we are all here, to be able to get CPD. That particular standard is under revision. There's a guidance on IS1 on how to look at entry requirements for professional accountants, and does the board do something to be able to address the issue of entry requirement? Because the standard says, as you admit a professional, an aspiring professional accountant, there must be reasonable assurance for that particular professional to be able to complete that particular course. We know all over the world that is a big problem because you have people who do part qualification and get into industry and never fully qualify as professional accountants. So that is one of the projects that is being addressed by the board. Then there's a new issue of specialization, banking, extractive industry, public sector. They are looking at how to be able to create standards that will address various specializations in terms of education, and lastly, being able to review the strategic work plan. I think for the public sector, I'll want to mention that it's a good thing that the country, Kenya, has adopted the public sector accounting standards. Through the Public Sector Accounting Standards Board, we have done, this should be our second cycle of reporting under the public sector accounting standards. But key to it is that the Public Sector Accounting Standards Board has not made significant changes to the standards, but there are projects that are ongoing that will be effective or maybe 1st of January 2018 that are going to affect how the reporting for public sector entities is going to be carried out. And basically the changes that have come through are in relation to the preference on the International Public Sector Accounting Standards Board, just being able to redefine. I know there was a challenge when the local Public Sector Accounting Standards Board was trying to classify entities. And the biggest challenge was the government business entities. And now the new standard has been, the standard is being revised and has been revised to be able to delete the term government business entities to what we call commercial public sector entities. And besides that is a whole of amendment that have resulted as a result of that to all the other provisions that related to government business entities, including IPSAS 1 on presentation of the financial statements. I think basically the projects and the developments that are going on under the Public Sector Accounting Standards Board is one to do with social benefits. We all are beneficiaries of one way or another to what the government offers in terms of lighting, in terms of water and all that. And there's a revision that is going on the social benefits, non-exchange expenses, which more or less related to the non-exchange revenue. What it simply means, you pay taxes. But when you pay that tax, there is no corresponding benefit that you get from the payment of tax, because that tax is going to go to various other activities that support various expenditures, and this is one of the areas that the board is looking at. There's issue of heritage assets, the public sector measurement, and leases. The issue of leases is because there's a new standard on leases, IFRS 16. The Public Sector Accounting Standards Board is trying to align that to the new standard, the IFRS 16. Additional work from the Public Sector Accounting Standards Board, the tax expenditure, the natural resources, all this, we should be able to provide a guidance on this as and when they are finalized. I think it's to be able to appreciate our government for the adoption of IPSAS. What is remaining is actually the automation of the reporting templates and being able to look at the work of the internal audit in the public sector and view the constituent work of the various parts within the public sector. I'll want to stop here. There is more to do with the ethical standards. There is communication from ICPAK dealing with SMPs, the accountability now. You'll allow me to stop at this point so that we provide a technical guidance through the Institute on all these areas. Thank you.
Thank you, CPA Michael and CPA Edwin. And when we look at the time, it's around 12:20. So what we are going to do is give Susan this opportunity to introduce FCPA Edward Ouko. And the aim is that we give him 30 minutes, and Susan will take also the session on question and answers. Thank you.
Thank you, CPA Jude. It's difficult to introduce FCPA Ouko because I'm one of his biggest clients working in the judiciary. But I hope this introduction will not temper his independence. So FCPA Ouko is the Auditor General of the Supreme Audit Office. He's a fellow of both the Institute of Certified Public Accountants of Kenya, our own, and the one of England and Wales. He's also a co-opted council member of the Institute of Wales representing Africa. He holds a Bachelor of Commerce degree in Finance and Accounting from the University of Nairobi. And before his appointment, FCPA Ouko was the Auditor General at the African Development Bank and was with the African Development Bank for 24 years, holding various positions. FCPA Ouko has 30 years experience in matters of auditing, accounting, and investigations. And prior to joining the bank in 1987, he worked in London, Nairobi for Deloitte, Harkins and Sells, one of the big 6 firms in the world. As he was later a staff manager, an audit manager at Deloitte, the Kenya office. I'm sure this CV is very long. We've tried to condense it, as CPA June said. But we cannot. We have to say who he is, as is. He's currently a member of the Audit and Risk Committee of Africa Capacity Building Foundation and a member of Advisory Board of Vietnam International Anti-Corruption Academy. As a convener of the Public Sector Committee, I'm sure most of you have interacted with him through the management letters. I told you I received so many pages from him, and I'm not complaining because we are partners in this journey of public finance. He always gives me a qualified report, and I'm working very hard to make it shorter and very good. Thank you. Welcome.
Thank you, Susan. I hope my slides are up and I can see them. First of all, let me apologize that I'm standing between you and this very delicious lunch which has been prepared outside. And I think that's for good reason, because of the sessions which I've just had. Very, very interesting. Mike, I think going through the standards was very interesting for me. I learned a lot, and therefore I feel that my CP points are really of value, and I think you too also will find it of value. You allow me, because it's very rare occasion that I stand here, that I make some recognitions. First of all, of course, I must recognize the chair of ICPAK and the CEO, my good friend, CPA Dr. Patrick, and many other CEO, the council members who are here. I would like specifically also to recognize some very important CPOs, and these are our CPO members of parliament who are here. I think I'd seen CPA Thomas Wadegu somewhere, and I'm glad to see CPA Kigo here in front of me. But equally important, I would like to make a recognition of a good old friend of mine who we've interacted many years, and that's CPA Ndungu Zinji. I think I would like to recognize you. I think we come a long way. I know your work in the international sphere. We've dealt, and really you can't be there and be standing here without recognizing you. Now, time is short. My topic is this, independent audit as drivers of economic development. I will skip a number of slides, so I'll have to go very fast. And therefore, I'll be talking very broadly until I reach a point which I think will be of specific of interest. Now, my talk will be more geared towards the public sector, and understandably so, because that's where I am. But as we talk of economic development, I think there can be no economic development with strong investment by government, but government invests through your money and through public resources which you have. So the public sector tone of my talk is quite going to be understandable. So broadly, I will look at just a brief scan of our constitution in terms of the issues of my mandate and how it relates and the challenges it's giving me. First of all, why I need to do a rethink outside the box and be able to deliver to you in the context of the new constitutional. So I'll scan that. Then I will come into a challenge which I'm facing, and that challenge is going to be a challenge which I'll throw to you, which is to say that I need to partner with you. So those are the things, and that means I will, I hope it is working. That's sort of the introductions. The constitutional basically have got checks and balances, and I think the slides are there, you look at them. But the most checks and balances is this diagram, which I want to show you so that you understand the context where we are and where the Auditor General is, and in the context of a new constitution, that our sovereignty is to the people, and it is the people who are the shareholders of us, of our resources, those public resources. Of course, you know the checks and balances are very much built into those arms of government. Now, one thing about our constitution is it has a very, very strong sense of governance with those checks and balances. And I think we all must be aware, we all must be aware of the national values, especially Article 10 of the Constitution. That is our bedrock. In fact, as we stand here, we are all aware. And that article really has got strong principles of governance, of transparency, integrity, and good governance. And that's the bedrock of our work. And we just talked about ethical issues here. So we can understand the environment under which we are now dealing with. We've done that. Now, in the context of my office is very much, its mandate rooted, of course, in Article 229 of the Constitution. And this basically Kenya divided itself from a unitary government to now two levels of governments, which are very much independent, but of course cooperating in a way. So in a way, I have one mother government and 47 mini Kenya governments. So the responsibility which I have for the national government is the same as the responsibility which I have for individual mini Kenyan governments, which are the counties, as you know. And that's a challenge which I'll refer to later. Now, my mandate has got also some very important provisions, and I think one provision which is just one line, but I think people do not read too much into it. People read a long list of accounts, you must report audit accounts. But when it goes to Article 2296, that mandate says that I actually should confirm that your resources have been lawfully and effectively applied. Now, we are auditors, we are accountants here. The implication of that confirm means the Kenyans wanted the Auditor General to start thinking outside the box. Because to confirm something, it means that I need to adopt a strategy which will not only say that the accounts are the certification of the accounts, that, they're true and fair, that's very good. But to confirm, it means somehow that I should actually also be having some, what I would call loosely as permanent, not continuous audit sort of work or presence in that context. And then beyond that, whether it is effective means that the outcomes of those resources have gone to the outcomes which we expect on the Wanjiko. So I see these are the three pillars, which is the certification of accounts. That's a fiscal responsibility, which is the expressing of the opinion. And in that pillar, I respond to various principles, various standards. So know that we also work for standards we respect. In some cases, like the corporations, we have to respect the IFRSs and many of the standards we are talking about. So I was really glad to be here, to be learning the updates. And these are some of the fundamental standards which actually, I back my work on. Those are the compliance guidelines. You have financial audit guidelines and the principles of financial auditing. And we've talked of the ICPAK, which of course also I espouse very much. So that's on that pillar. The second pillar would require me, I think, to be more proactive or do work which is more proactive, which is going preventative and deterrence. And this is the one which is now going to respond to the lawfulness in the context of trying to look at the wastages, misuse, and issues of fraud, and dare say now corruption, and other irregularities in the management of our resources. And that's the managerial accountability. And that's the second pillar which I have to respond to. And in so doing, again, I respond to certain standards, and these are the, I say 12, the issue of value and benefit, okay? Making a difference to the citizen. The issues of internal controls in the public sector, these are all standards which we try to ensure are there, and generally enhancing good governance. And again, the issues of transparency and accountability, the Article 10 of our Constitution. Now, Pillar 3 is one which now I basically say this is really designed to respond effectively to our Chapter 4 of the Constitution, which is called the Bill of Rights. I think when the Constitution was saying these resources are effectively used, in my humble definition and understanding, that it is effectively used to respond to a key Bill of Rights, and that is the accountability for service delivery. Our Constitution is very strong, and it was very based on service delivery at the lowest level. So whatever we do, the monies which we see, we must assess whether, to a certain extent, there is what I would call roughly as value for money in terms of results, output, and outcomes. That would positively respond to the Bill of Rights which we have in our Constitution. Now, those Bill of Rights resonate directly to what we talk about when we talk about development. They resonate to sustainable development goals. And this is the challenge which I have to respond to. So the work which I do under Pillar 3 must respond to answering those, and therefore it must respond to the Sustainable Development Goals, which looks at the rights to health, right to food security, employment, education, environment, and as size of which I chair some sessions of the Supreme Audit Institutions of Africa, because I'm also the knowledge sharing of the AFROSAI chair and also the capacity building chair for the AFROSAI-E, that is the size who are English speaking. We are looking forward to this new ASAI, which is coming over. That is the role, our role in sustainable development. So you can see the thinking of our constitution, the thinking of what we have in our provisions is very much responding to the thinking of the international world as a whole and the UN adopted sustainable development goals. Now, clearly what I've said, you must ask, I'm not, I don't know, a magic man who can respond to those two levels of government in the way which the Constitution requires me, in the way which it requires me to certify the accounts, ensure that they are managed well, and it has given the desired output. Therefore, the major challenge is how I will and how I should scope my audit or respond to the wide scope and coverage of the county government audits. And partly I'll be doing continuous. That's one challenge which I'll come back to later why I need you. The second challenge, of course, is to increasingly make sure that if the checks and balances are strong, the acts which root my work, the legal framework, is also strong. We recently passed the Public Audit Act. We have problems with some of the provisions. I leave it to you. You have to look at that. Then there's the other challenge, which when I'm talking about, I'm going to talk about the county governments. It will basically come, and that is the issues of assets and liabilities, both at the national and at the county government. My logic here is that with the new constitution, and since we devolved two levels of government, we have not as a country told the governors what were their opening balance sheets. And I think it behoves us as Kenyans and as us here as ICPAK members to push that we need to have, having divided the government into two levels, we need to have known what assets are remaining at the first level and what assets have been given to the second level. As accountants, there's no way I can opine on the accounts of each of the counties unless I know that there was an opening balance sheet, which I can't, because it's not there. We just moved into two levels in a way that thinks, business as usual. But we have to insist that we as accountants, we must get the opening balance sheets. It can be done anytime and backdated of each county. Because going forward, we would like to have to account for the counties in the context of what their capital stock is. In other words, when I'm auditing a county, I'm auditing the capital stock of a county. And hence, we would be able to see whether the counties are progressing, whether the development is adding to the capital stock. If it is minus in capital stock because of heavy liabilities, we also should know. But we cannot do that until we do that. And I believe, and I'm sure, that with the challenge I'm going to talk about, we can do it. So that's a challenge to you. And that's where, the independent audit, which you are, you need to be drivers, very firmly drivers into these things which I'm going to talk about. So I'm going to talk about some of the challenges which we have and whereby we need you as drivers, independent auditors. There are many, but let me just be very simple in terms of the counties. The first of all is incomplete records. They are struggling. In the first 6 months, I had really a difficult time to know whether, in fact, people just knew that they just can spend money. Recording was not an issue, or they spend money and then when the audit comes, oh, these invoices are there in the backyard, whatever. So it was a lot of chaos, but things have developed, have moved on. They are now trying to put into some form of systems to record things, to file things. So we are getting better. And the other one was, we are so many, but in the counties, we are very thin, there's very thin financial expertise. Then the third one, of course, I've talked about is the issue of assets and liability. There are many others, but these are the ones, because I believe these are my major challenges. And for me to overcome them, I'll need to work and partner with Kenyans of goodwill like ourselves here. And I think you, the members of our cherished institute, we are now being called to a challenge. Can we be able to give this country a national assets and liability, a national and county national assets, county assets and liability? Can we or can we not? Me, I believe, yes, we can. So that's a challenge which I'm leaving here. Even as a partner with you, I'll need you, and we need to know how we're going to partner. Can we also help the counties in terms of expertise of accounting? Yes, we can. So what does that mean? That means I need to find a framework by which I can seriously outsource work to you, or you can be a partner to me in responding to our national values, the accountability. And really, I want us to take this very seriously. And on my side, I know that the outsourcing is very important. So what have I done to work with and to give you, to make sure that you are strong drivers in this economic development? I've decided to work on a framework for outsourcing of audit services, which I'm very thankful to ICPAK. They've worked with me and we've agreed on how we are going to have a framework whereby I can start outsourcing the work to you. And this framework is based on categorization of firms. We consider this, and I think, your feedback will be very important, but the categorization of firms which I will need to work with. My point here is that, hitherto, this outsourcing has not been in a way that I'd like, because I found it there and it has been going like that. And I think we need to start having a system whereby we can partner and outsource in a manner that is transparent and in a manner that will bring some form of equity. You are many here. You are many. And the job which I have are also limited. Not very many, but limited. So, in other words, how will I choose A from B? So what we felt that, I asked ICPAK that let us agree on categorization of firms, some principles of categorization, which is these 5 categories. I won't go through them, but the intention was that once I know the categories and I know my mandate, and take for category A, I have the corporations, I know their asset basis, I know how strong they are, I know their possibility. Then when I have work, I know that I can go to category A and ask them to. Now mine is to make sure that over a period of time, through rotation, that I've given equal share to this so-called category A firms, but also in the process, some lower category A firms are also moving up. Such that in the longer term, I think whenever there is work, I should not give more technical value just because somebody had an experience of auditing one company. Because at the moment what I find that certain critical institution of ours is being audited by sometimes just 1 or 2, 3 firms. So when you find the next, we ask them to bid for the jobs, you find that there is one who has been given a little bit less marks because has had no experience in auditing there. And I think that is unfair, because for critical institutions, we should be building facilities and capacities such that we have more of our category, I think at this stage, category A firms, who can actually be called upon. And in fact, in the longer term, also called upon to reduce the cost, but also in a way that the lower part of category A will be fighting to be even bigger or whatever. So those are the driving principles which made us work with that. And in the context, we are still refining it. And therefore, for the decision I've made is that from now on, even the category A bids which are coming in, even though they are evaluated, I'll have to look at it. And sometimes, because of rotation, I might have to take a cheaper and a slightly more expensive or slightly cheaper one, or sometimes not automatically have that 2-term business going on. So that will create a problem, which I know, because some firms will feel that they may be unfairly, they deserve the new second term, but they don't have. But it will be purely because of responding to these principles which I have here. The category B firms is very interesting. There are quite a number. And we now then go to numbers in terms of partnership and so forth, category 2 and 3. And then there is what we call the sole practitioners. You know, the work which I'm going to do, especially at the counties, and especially the work which responds to confirming lawfulness and effectiveness, would mean that I'll need to partner with people within the counties to be able to do certain part of work for me to bring it into my reporting. And that's where I want to say that there's quite a number of you, and I think you have to start organizing yourself to be on the ground in your counties, in counties where I can count on you and say, you really know the county. I'll be able to do this work. For instance, I would like that in the future, I audit according to the budget line of each county. In other words, I would pick up, I don't know, in Kisumu, the health budget, in Kiambu, I pick up the education budget, and just go through the process the principle which I'm telling my staff, that we are going to audit the shilling from the budget, accounting, and up to where it hits the ground. And where it hits the ground is where now I have this category E, or not only category E, but Kenyans of reputable, integrity, who are on the ground, who I can outsource that bit of work, work which goes towards value for money, work which goes towards verification of assets, work which goes towards, existence tests and so forth, such that when I look at the development budget of a county, I can say, yes, this is the budget, these are the projects which you anticipated, this is how much you've spent, this is what is on the ground, and it will be surely what is on the ground. And therefore, the reports which I give will be one which transfers accountability not to Hello, but gives it back to Wanjiku. So whether Wanjiku can question through my reports how we have managed our assets. Now, I know time is of essence, but I really must now start to talking, because I really have a lot of things to say. But let me conclude that really the role of my office goes beyond the audit of giving assurance, and there's hope to partner together. We require your skills, expertise, and know-how to move this country forward. In other words, we require you to give assurance to Wanjiku. And I believe in so doing, you'll really be responding to be true drivers to economic development. I thank you all for listening.
Thank you so much, FCPA Onko. I think I would like us to clap for him. Not that way. Sorry, I was going to teach you how to do it. Let's look for fruits so that we give him to have very good eyesight to be able to perform his mandate in the Constitution. So we look for fruits like this and then we gave him. So can we look for more? Thank you so much. I will not go into a lot of stories or trying to summarize what the three speakers have said, because from where I was seated, I could see the attention. You are very alert. I'm sure you've written quite a number of questions you would like to ask. And at the same time, we have just 15 minutes to your lunch, so we'll be very fast. Some of the questions, you can write them down and pass them over, even on the internet platform, or is it the digital platform? We are very responsive and very fast. So I'll start on this side. Which order do we do it? We'll start with the two speakers. So since there were three speakers, you will say the question whom you are directing to. So I'm not ignoring you, you are an honorable member, but I want to start on this side. No hand on this side? Oh, there is one there. You tell us the speaker you are directing the question to.
The Auditor General, and part of the question will go to the CPA. Well, Ken Nyamolo is my name. My question would partly go to fellow CPA Dr. Ouko, and partly Mheshimiwa Kigonjenga, Waweru na wenzake. Good governance anywhere in the world is about institutions. And one of the institutions that we need to create is the Independent Audit Office. If Dr. Ouko was to tell us how he gets his funds that you receive, I think we need, through the members of parliament, perhaps to establish a way that that institution receives its funds more directly. Because otherwise, if you go very hard on us, then we will chip off your limbs by perhaps holding the funds. So, Waheshimiwa, as we are talking, as part of making that office as independent as it's supposed to be, let us consider putting clearly that into the Public Audit Act. And of course, that goes hand in hand with the staffing. A lot has also been said about AQA, Audit Quality Assurance, the reports, the staffs, and now that you're also outsourcing. It is important that perhaps we have a review or a purview of how the same quality is going to be validated within those three particular components. Thank you very much.
So this, then we have the last one there on that row, then they respond, then we come here.
Yes.
Okay.
I would like to direct my question to FCPA Edward Ouko. My name is CPA Philip Omondi from KEMSA. Now, I would like to divert a bit and direct the question related more with the procurement. I think one of our concerns, as you rightly put it, and it's also a concern to your institution, is wastage. Now, the new Procurement and Disposal Act seems to have actually, according to me, and I believe most of us here are also concerned, seems to have actually weakened the controls that were there before. I don't know what's your view about this new Procurement and Disposal Act, because we can see now the decisions are now basically based on two very important people in the institution. That's the CEO and the procurement manager. I don't know what's your view as far as this new Procurement Act is concerned, as far as wastage is concerned. Thank you.
So the last one before he responds. Yeah.
Okay, thank you. I'm CPA Wainaina from Dream Credit. My question is directed to CPA Ouko, and it's on lack of assets and liabilities in county government. I don't agree with you on that one, because prior to the county governments coming into being, there were local authorities. In every county, there were a couple of local authorities. And it was a precondition for local authorities to access LATIF to produce audited accounts. So my own understanding is that, for example, if you take Kiambu County, you are supposed to consolidate the accounts for Kikuyu Municipality, Remuru, Thika, etc. And those accounts were being done by CPAs. Not unless you are telling us what CPAs were doing for local authorities to access LATIF, it was fake. You know, nowadays accountants, we are being told we are cooks. We are good in cooking books. Is it true? I think I've written even an opinion article in an accountant journal, because Transitional Authority wanted about 3 billion to do a verification. That's a waste of public funds. Local authorities had audited accounts. Why can't we consolidate those accounts and get opening balances? Thank you.
FCPA huko. You can respond to the three.
Let me stand up. Thank you very much for these very useful questions. CPA Ken, I think the independence is something we all continue to struggle with. And how do I receive my funds? I receive them from Treasury. The issue is not how do you receive the funds, but how is my budget determined? Who effectively determines my budget? That's the problem, and that's still an issue which we are struggling with. So that's a very important thing. And the outsourcing and maintaining quality, another framework I think for me will be to ensure that firms we work with are clearly compliant, and any information I get of lack of quality will be leading to, you know, some sanctions or some sanctions from ICPAK. CPA Philip, you want the view about the procurement rules and the fact that it seems to be weakened the existing. Let me just say, first of all, from where I stand, I think the problem procurement is a real one in Kenya, because it is one which actually must be looked at, whether is it helping the development or whether it is retarding development. And here in Kenya, people are getting scared even to procure, because you know the minute you touch this, somebody else is. So we have to be very careful whether, before we say this one is weakening the controls or this one was stronger than before the controls, we must look at having procurements which is going to go towards bringing the right development actions. In other words, are we going to, our projects, development projects, are we going to bring them on stream quicker or less? So there must be a sacrifice somewhere, depending on what you decide. So that's my view. Very good. The local authorities, of course they've been accounting for, and of course you've been auditing them. But you've been auditing them as dots all over the place. Now, when you talk of Kiambu, what's that, the output? The output, I don't think, is just simple addition of those consolidations. It's not an accounting consolidation of those balances, because some of them were not even right in the first place. I know it's audited, but may not have been correct. But I think the point is this, is once we draw the map of Kiambu, let us now try and develop a capital stock for Kiambu to do a balance sheet, which will take into account those local authority audited accounts, but then it is got to be more made clear by verification There's need to go and verify that what is those which you audited actually are on the ground, they exist. Then they are validated, they are then recorded in the context of the county, and then they are valued accordingly for us to be able then to say that the capital stock or the assets and liabilities of Kiambu as of today is this. So very good work has been done. The point is that it is not a mechanical consolidation. It has to be a serious value consolidation. So the work has to be done. There is still the verification, validation, and valuation, which has to be done again, to then give the governors what exactly what they are inheriting as under the Constitution as a County A or County B. So it's not a question of underestimating the work which has been done. I think the point is that use all the work which has been done. And in fact, that's what we have helped the former TA to do. To try and use these very many records which have been done so that at this stage we have on paper what appears to be on paper the assets and liabilities. What is remaining is exactly the verification, validation, and consolidation of those assets. And that's what I'm saying, assets and liability verification. Let us be very clear about that. Thank you.
So I come to this row now. Honorable Mheshimiwa, where is the mic? Then the director, and then the two ladies, Jacinta and yeah. You tell us the question whom you are directing to, because we had 3 speakers.
Thank you very much, CPA Susan. I am CPA Kigo Jenga, Member of Parliament for Gatundu North. I do serve in the Budget Committee of Parliament, and I know you are my clients as well, alongside Dr. Uko. Recently, we came up with a constitutional audit which we involved your office very seriously. A constitutional audit that addressed the constraints that are handling or that are limiting your scope. And I thought this is a very important approach that we did, that if shared by these members of ICPAK, and if we could rob it from these members of ICPAK, then we could actually get you out of that limitation. How far have you gone with it? Is it going to address your problems that you've given us here that are constitutional? 2, you've spoken about direct funding. You remember this issue was before my committee, and I really proposed that you should be more independent and that you could be funded independently and you audit independently instead of relying on your clients, the treasury, and others who can equally limit your scope. And I remember as a committee, we requested you to also look, what can we do to get you out of the legal handle limiting you? And remember even how fast we have really worked for you to raise your budget from 1 billion to 4 billion this current financial year. Finally, is the issue of sourcing. Remember, it came from me, 2013, when I was new in Parliament, 2014. And now, you've come up with a framework. That is quite good. But what I'm asking you, when you say that you're going to come up with auditors who are actually from a county, are you considering the issue of independence? If you take me to Kiambu, my county, do you expect that I will not actually, my reports will not be assisted? And I remember asking you last year, what have you done to decentralize your offices from the central place in Nairobi down to the sub-county and the county? How far have you gone with that? Because I think everybody is decentralizing services for effectiveness, timeliness, and efficiency. Thank you, CPA Susan.
Very, very passionate. Next.
Thank you, Susan. My name is CPA Jacinta Mwendo, founder chair of Eastern Rancher. And my question goes to Michael. Michael, you talked something about the changes which are happening in the the proposals and all that. But I'm worried about the lease. You've talked of us recognizing lease in the balance sheet and all that. So my problem is we've been having issues where accountants are being told that they are cooking books here and there because figures are changing every year out, year in. What have you done, or what is the proposal being driving us into? Are we getting into more problems than we were before? Because how would you put something 15 billion and then the other time we are talking about 10 billion or 8 billion? Are we degrading ourselves, or are we moving forward? Thank you.
Next.
Thank you. Okay, thank you. I'm CPA Elizabeth Gorenga, working in the Office of Auditor General, and I would like to take this opportunity to thank the three presenters, especially my boss also. And one thing I would really like to say in this particular forum, I think it is important for us accountants to take matters of this nation with a lot of importance, or the seriousness that it deserves, because I remember sometimes back before the promulgation of the new constitution, I asked whether we had costed the constitution, and I remember one of my colleagues stood up and said that he does not expect an accountant to ask such a question. And once again, the government now allocated quite a lot of money to do or to cost the constitution. So I think we need to fully participate in that. And my other clarification that I would like to I would like to clarify, there is the issue of the audit of the local authorities' fixed assets. I remember out of the 175 local authorities, most of the reports were qualified reports. I happened to audit quite a number of them. And one of the major qualifications is that they did not keep or maintain a fixed asset register. And as such, if there was no fixed asset register, it was very hard for us to verify that. And I think the audit exercise that has been going on was very important for us and for everybody, because as I'm saying, out of the 175 former local authorities, we used to give all of them qualified reports. Thank you.
Okay.
Thank you very much. My name is CPA Kenyoro. I work for Housing Finance. I think my hand was up quite some time. I'm so close to Susan, she did not recognize that.
Sorry for that.
Okay, good. Mine is to CPA Michael, and this is on impairment. This is a big thing in the banking industry, where provisioning is a big thing. Case in point is National Bank. Recently, when they restated their financials, you realized the huge profit turned to negative. This because of the underprovisions that were there. Micro in banks, we have two sets of provisions. According to the regulator, CBK, whose method is based on the period the loan is in arrears, and for financial statements, according to IFRS. This leads to a lot of reconciliations at the end of the day. And I'm asking if there is anything the Institute can do to really convince CBK that IFRS method can serve their purpose. Thank you.
Thank you all. So I think, Michael, CPA Michael, you have two questions. I will allow you to come, and then FCPA Oko will respond to the honorable members. I believe Elizabeth was a comment. It wasn't a question.
Thank you, CPA Ayasi. Two questions. I think the first one that go was CPA Jacinta around the new leases standard, the IFRS 16. And if I got it right, you're asking whether this is another opportunity for preparers to actually present misleading information. Now, the standard is actually got very clear guidelines and principles that are supposed to be followed in accounting for leases and how they need to be brought onto the balance sheet. It actually gives exemptions on so-called short-term trivial lease arrangements, like leases of vehicles or buildings for very short-term periods and all that. So those things should not actually come into play. Where you've got leases that are of long-term nature, it actually gives very clear guidance on how do you determine the amounts and the balances that you need to book on your balance sheet. So again, it's a well-written standard. The principles are very clear. It goes back to us as accountants, how we make sure that it's actually properly enforced and consistently applied year on year, so that you don't have 1 year the leases are on the balance sheet at 100 billion, the following year they're at 50 billion, and nobody can tell how those numbers are moving. So the standard is actually very robust and very well written. The second one is actually a very interesting question from CPA Kanyoro around the impairment of loans and advances in banks. The issue of impairment actually for loans and advances in banks is not an issue of inconsistency of IFRS and CBK prudential guidelines. In my view, the issue is the robustness of the estimates and the models that our banks are using to enforce the impairment provisions they need to book in their books, whether it is IFRS, whether it's CBK. The rules are very clear, whether you're using the prudential guidelines or the IFRS, the rules are very clear on how you should apply them. It goes back on us as accountants, what are we doing to make sure that those rules are properly applied, the estimates that are made, the judgments are made that are robust and they're actually defensible in the way we prepare financial statements. Should you actually be asking CBK that the IFRS basis is adequate? Probably not, because actually the CBK basis is more prudent. And that's why it's so-called prudential guidelines. It allows you to go over and above the IFRS in the way you book your impairment, in the sense that it takes in more of a risk-cautious approach. And it tells you that where you've got actually considerations where your impairment is more than what the IFRS basis is, you book what is called the credit risk reserve on your balance sheet to cover you for the potential loss that IFRS might have fully booked. Now, how does that arise? Is the IFRS tells you if you've got a bad loan, you look at the collateral you are holding. Most of the banks will tell you, I've got land as my security. And how IFRS approaches is that you've got 10 billion, it's gone bad, you go back and say, I've got the land as security or the building as security, I'll sell the building, I'll get 15 billion, and therefore I'm fully covered. How long will it take you to sell that building? The bank, the first thing, any preparer will tell you it will take me 1 year. Will it be done in 1 year? No. So you find the impairment has actually been booked, it's minimal. In the case of CBK, they go with the time limits over what period has that loan been in default, and then depending on that classification, the impairment follows that period. And at times you have to book then more. So in my view, CBK approach is actually fine. It probably needs to be looked at and enhanced, but I do not think there's actually any problems between those two approaches. Thank you.
Thank you. CPA Kigo, you know the Constitution, we've audited it, but you know, the Constitution actually says that it is you, Member of Parliament, who should determine how much you want to give me. It's not me to determine. So really, how will we address that? I think we try to address it in the Public Audit Act, which was passed, but I think that element was missed out. I think despite our trying as much as possible to ensure that the budget of the auditors is really determined well in advance of even the policy budget statement comes in, whereby the auditor should present to you, the parliamentarians, what they intend to do, what he intends to do. Then you can then say, yes, these are the resources you require, this is what we'll give you. It is your decision. I can do, but only to present the plans. And that one I've tried, and so it is really, I hope we can do something about that. And I'm glad and congratulate I think you are in the reconstituted back, so I'm looking forward to support. Now, the issues of outsourcing and independence. I think let us not confuse the risks of outsourcing and independence. Yes, to get somebody from Kiambu to audit Kiambu, there's a risk that that person will be compromised. But then there is a mitigation you can have. If it is that, then you make sure that the person who pays that person in Kiambu to do the audit is not the Kiambu governor. It is money which comes from the Auditor General's office, money which, in the light of what I've said, I'm really coming back to you as a member of parliament to put amount which will be for the outsourcing, so that I pay you directly, and therefore when you work more independent, because your payment is not being paid by the governor you're auditing. But also I tend to find that when I shield you, even with the big firms, that they tend to work better and more independently, and they tend to really go out of their way to say things as they are, rather than when, say, an institution directly contracts any of the firms to do something, to do a work, because then there's Kenya politics is something which. So we don't need to do that. I think we don't need to fear, but this is why we'll be out. It does not mean that we'll always be saying that only Kiambu can audit Kiambu. This thing will be done, but what I'm just saying, there are some circumstances whereby if we talk with you well and we assure you well, you'll do better work. And there are Kenyans who are ready to do better work that way. Now, the centralization of my office is very important, because I just say that I need to be more present. And this again is a question of budget. Right now I'm operating from hubs, and these hubs have to cover in one hub about 7 counties, and the same staff. And I'm required to report at the same time in all these 7 counties, and I've got the same stock of staff. So staff can only be in one county at the same time, So I cannot audit all those counties at the same time with the same staff which I have. So staff really are stretched. They are stretched, they work 24 hours to try and get not only the national, but the challenge is also the county. Because in each county there are 2 sets of accounts which have to be opined on. That's the county assembly and the county executive. So we have 98 sets of accounts to opine on. So we are decentralizing, we are in hubs, but eventually we are trying to make sure that in the bigger ones we are going to have presence of our staff, but that requires numbers of staff. Thank you, and I count on your support. I think Elizabeth has explained, and thank you for the clarification. And the assets which we are talking about in a county, by the way, is not only the assets and liabilities which you see in the financial balance sheet. There's a number of biological assets. There's a number of issues which we need to bring into a county. Some have got very good game parks. Some have got trees, things which have to come in. So that's the context, CP Arena, which we are talking about, this assets and liability verification. Thank you very much.
We have to go very fast because of time. So I'll reduce the number. I want 3 to go. Or we agree that we'll give you a very short time, mkule kama an army man, so that you are back very fast. Bwana CEO utanisaidia to make the decision. 1, 3 questions. 1, 1, 1. It's a difficult choice. Let me have this gentleman there. You can write the others. Please, right, we will respond. We'll give to the presenters.
My name is CPA Richard Koech. My concern is directed to fellow CPA, Dr. Uko. I think the first one he has already answered through Mheshimiwa's question on the pillar of continuous audit presence. Really, I don't know how realistic that is, because at the moment, the continuous presence is not really continuous. Since your audit is done once in a year, where you combine maybe, of course, the systems, the traditional systems audit together with the financial statements. So I think the Auditor General may be economical with the truth in his challenges, the capacity. I think that is something that needs to be said well and taken care of, because the capacity, as he has put it. The other concern is about
Can you give one question so that we give another chance?
Let me put it the last one. That the audit of counties, the audit reports for county governments is supposed to be discussed in the county assemblies, according to PFM. At the current situation is that the Senate has taken up this role of going through the audit reports and summoning governors. In my view, I think the law is clear on who is supposed to check on the audit reports. And also at the same time, counties are governments. In Parliament, in the National Assembly, the ICPAK does not summon the president. They are accounting officers for each ministry. Equally, in the counties, they are accounting officers. I wouldn't wish that the governor is really the chief executive. He's the president. It's a government. It's not a parastatal. Thank you.
The second last. There's somebody in white, yes.
Thank you. My name is CPA Wilson Wambia. The first question I have is to CPA Michael, and this is on the operating lease. Just wondering, what are the benefits of having this in our financial statements, especially the short one and even the longer one?
A bit louder. We can't hear you.
I'm saying, my name is CPA Wilson Wambia. The first question goes to CPA Michael, and this is on the IFRS 16 operating lease. What benefits do we get by having this in our financial statements, whether it's a longer period? Let me go back to audit, FCPA UCO. The first thing is, after your opinion, qualified opinion, what next? Madam, you said clearly that you've been having these qualified opinions. What next? You've talked about bookkeeping and opening balances with the counties. Is it that CPAs are failing? What is it that we've done that we can do for them? And lastly, audit timing and the reports. At what time do the audits start, and do we give the report so that we're able to arrest so many issues that come out of the county?
The last one. The last question. One question, please. That's the last one. We close.
Thank you. My name is CPA Sylvester Kini from the Office of the Auditor General. Mine, I have actually one question which I wanted to, because it has impact. And this one question is, it's about the public sector, whereby the Public Sector Accounting Standard Board still prescribed IPSAS cash. When you look at the sector where we are using IPSAS cash, that is like 80%. The national government and the county government, and also the CDF. We have our neighboring countries who has gone to IPSAS accrual. There are so many aspects which we are losing when we are talking about economic development. When you expense a Prado and it has disappeared, you can't account for it. So I think this question goes to ICPAK, Bwana Makori, which sits in that board. I think this is something which we need to fast track, and we ensure that our public sector is at least audited via IPSAS accrual. That will be very important. Last but not the least, my colleague has said that the de facto county local authorities, their financial statements were qualified. In fact, they were not qualified. Actually, 50% were disclaimer. How can you consolidate a disclaimer? That is my point. Thank you.
Thank you. I think CPA Michael, you'll answer, and then FCPA Ouko to complete.
Yeah, can I just save time by not standing up? I think, as I said, is that I covered these things at very high level, and I advise you to talk to your advisors around the financial reporting. The whole issue behind IFRS 16 and why you need to capitalize some of your operating leases is actually complicated. If you've got an asset, a building, which you've leased for 30 years, those 30 years could be substantially the useful life of that building. By the end of that lease, when you actually give it to the owner, that building possibly needs to be completely redone or actually brought down. What would have happened that over the 30 years, what you'd have been actually only doing is you've been expensing this building as an expense in your P&L as the rent that you're actually paying. Had you capitalized that building, because you're actually going to use it substantially, its useful life, you'd have actually ended up with a financing cost in the sense that effectively you actually bought this building and you then was financing through lease payments. So it's a completely technically complicated thing. It brings a completely different measure and how the stakeholders can look at the performance of your business. So just talk to your financial advisors. There is very good technical arguments behind the standards and the benefits for it. Yeah.
Yeah, I need to be very quick. CPA Koech, I think I'm not trying to, say what if I told you I was responding to the new constitution and our strategy. So please don't confuse the strategy and our hope with assuming that I'm already doing it. I'm not yet doing it. I'm not economical with it. I was actually saying the truth. Please. The issue of county assembly and all that. In another constitution, I think it is the county assembly which should oversight the governors, because that's how it is in the structure of the two levels of government. Now, Senate is also trying to find its area in this overall context of governance, because they also have a responsibility towards that. But if you ask my view, it is the county assembly which should oversight the governor. But that doesn't mean that Senate doesn't have a role somewhere. Now, I think, CPA Wamba, the issue of qualified opinion and what next, I think these are very clear. I think my reports go to the PAK. PAK is the primary oversight, and they have to make the decision. All right, so this comes out. And I don't know what you talk about opening balances, whether we failed or not. I think it's just a challenge which we have to live up to ensure that we help as professionals, the counties. The timing of audits, in principle, the Constitution requires us to report at the end of 31st December, but obviously that's not practical in view of the challenges which I've just told you. And that's why we are looking for issues of budget to be able to deliver and respond to these deadlines. Thank you. And now the IPSAS CAS is a big problem. I think we have the standards board, which I think is seized with this matter. Or maybe CPA Edwin can respond.
Thank you, CPA Kiri. You addressed the question of IPSAS cash. I think what you need to also realize is that the adoption of IPSAS all over the world has taken a process. I'll give the example of UK, Switzerland, and Australia. They had to start from a point where IPSAS cash was the initial template as they transitioned to accrual, IPSAS accrual. are doing currently is just to be able first to have the public sector entities to appreciate the public sector accounting standards, and the point becomes now the IPSAS cash. As now we do the actual transition, and there are transitional provisions as you move from IPSAS cash to IPSAS accrual. I think it would be unfair to immediately transform entities that had just a fund statement to an IPSAS accrual basis. So we have to see how do we walk the journey by putting them first on IPSAS cash, then transition them to IPSAS on accrual basis.
Thank you all. The mementos will be presented as follows. FCPA UCO will be presented by our National Vice Chair. And then CPA Mukasa will be given by FCPA Ndungu Kavingi. And then Edwin will be given by Georgette of Rwanda, Institute of Rwanda. Tom. Please come and guide us on the way forward. Thank you very much for being attentive. I now hand over to Tom to guide us on the way forward.
A round of applause for the session leaders. So I just want us to break for lunch. We've lost some time, but let's be back by 2:30. We have 2 sessions in the afternoon. So let's try to keep time as much as we can. Let's be back by 2:30. We get seated. Thank you very much.